Maximizing your income with Roth conversions. Let's explore the pros and cons, if this makes sense to you. What is a Roth conversion? And why are Roth conversions important in retirement planning? Those are the issues that I want to discuss with you today. The advantage of Roth conversion is once you convert a taxable account to a tax-free account such as a Roth, your withdrawals are tax-free on distribution. Very important features, there are no required minimum distributions, or as they refer to them as RMDs. Once it's converted and you're at retirement, you're taking money, you're not subject to the RMD tables that the government forces on you. And this, you can also be potentially in a lower tax brackets during retirement, perhaps. Depends upon what the government does with our income tax schedules. And then there are estate planning benefits that are very important that we will discuss. Roth IRAs provide flexible withdrawal features that are much more conducive than just a regular pre-tax account such as an IRA or 401k. And you do have the potential for a lower future tax liability, maybe. And of course, you have the ability to leave tax-free income to your heirs, because if it's in a tax-free account, you're not being forced to push the money out to your family, which would be subject to taxation if it were pre-tax. It could reduce your cash flow for tax payments if you were taking the money out of your current assets and paying your taxes. And of course, the other unknown is consideration of future tax laws. None of us know what Congress is going to do as far as taxation in the future, which in my opinion, I think is going to be higher. And it can impact certain tax deductions and credits in the future that when you're filing your income tax down the road. And another very important feature is to be cognizant about the impact on Social Security and the benefits you're receiving, because it could push you into a higher total overall earnings category, which would increase your taxes and subject a larger amount of your Social Security to taxation. The considerations that you must have before converting is, looking at your current and, your potential tax brackets in the future. And two, you've got to, what's very important is that time horizon until retirement. If you're not already retired, you got a little more flexibility if you do prior to your full retirement age. And you have another thing that you got to be cognizant of is where will you pay the taxes from? Will you be taking it out of your current asset pool, or will you take it out of the gross amount that you take out of your IRA to convert to a Roth, thus netting you a lower amount? You've got to consider the impact on your other retirement accounts so that you're coordinating a Roth conversion parallel with your other accounts. And the most important feature is the 5-year rule. If you do convert to a Roth, your first conversion, those assets have to be in the account for 5 years in order to not be subject to any penalty tax, which can occur prior to 59 and a half. But, you've got to be cognizant about that, because it could create an unexpected tax liability. Here's some strategies for mitigating disadvantages. You can do a partial conversion. That means you don't convert all of it at one time, and you can spread your taxes over multiple years. Once a Roth is converted, you can't go back, so you can't mitigate the risk there. So a regular IRA has some flexibility of moving from one IRA to another, but a Roth conversion is one and done. So I hope you found this helpful. I would encourage you to seek professional advice, making sure that you're doing this in the correct fashion so that you don't have any unexpected surprises. And most importantly, it must be a part of your overall personalized retirement planning process.